By Thursday night, we'll know whether Friday's ugly retail sales number was the start of something or just one bad morning. Because in the span of 3 trading days, Home Depot, Target, Lowe's, and Walmart are all about to tell us, on the record, whether the American consumer is actually cracking. Good morning. It's Sunday, August 16th. I'm Nick Vertucci with Ashley Reyes and Marcus Brooks. No futures check today, no what's on deck this morning. This is the week ahead, the calendar, the earnings slate, and the one theme most likely to actually move this market before Friday's close. Ashley, Marcus, where do we start?
Honestly, with the thing that's not even reporting anything this week, Jackson Hole. 2 weeks out now, and it's Warsh's first one as chair.
And by his own admission, he doesn't know what he's going to say yet. Called his own speech a blank piece of paper a few weeks back.
Which is either refreshingly honest or a little terrifying, depending on how you like your Fed chairs.
I like mine with a plan. But fine, we'll get to Jackson Hole properly. It's not this week's story, it's the deadline this week's story is racing toward.
Quick scoreboard note before we get into it. For anyone keeping score, nobody made a new call yesterday, so there's nothing to grade this morning.
Overseas.
She's still 5 games under. I'll take my 1-game cushion and enjoy it while it lasts.
It's not going to last.
We do still have 2 calls sitting on the board from Friday, unresolved. Yours on the 10-year, Ashley, and yours on Lam Research and KLA, Marcus, both marked for Monday. Markets were closed all weekend, so neither one's graded yet.
Right, those are Monday's problem.
Today's problem is the calendar. Ashley, you started us at Jackson Hole. Back up one step first, because Wednesday matters more this week.
Wednesday afternoon, we get the minutes from the July 28th, 29th meeting. The one where 3 officials actually dissented in favor of a hike. 3. At a meeting, Warsh himself chaired.
Remind people why that's still relevant 3 weeks later.
Because that dissent happened before the soft jobs report, before cool CPI, before flat PPI. Hike odds on the Fed funds contract went from something like 82% right after that meeting to under 20 now. The minutes are a photograph of a committee that was a lot more split than the market's pricing today.
I think you're reading old news like it's breaking news, though. 3 weeks is an eternity in this cycle. The data that convinced everyone else already convinced the market. The minutes are a rearview mirror.
Rearview mirrors tell you who's still driving too fast. If those 3 dissenters show up in the text with real conviction, not just a footnote, that's a signal. Some of this committee needs a lot more than one soft jobs report to get comfortable, and Jackson Hole becomes the place that fight actually.
Or it's 3 names who already lost the vote, and Wednesday's just a paragraph acknowledging they lost it. I don't think this move yields much either way.
Put a number on it. What would actually surprise you?
If the minutes show real debate about inflation being stickier than the headline suggests. Not 3 names in a footnote, an actual fight. That's a yield spike. And Jackson Hole goes from, here's the new framework, to please explain yourself.
And Jackson Hole itself, what's Warsh actually walking into?
His first one is chair, and the theme this year is financial innovation. Payments, stablecoins, the whole digital money stack. Very different agenda than, what do we do about inflation?
Which might be exactly why he picked it. Nobody expects a first-year chair to redefine the whole policy framework in front of every central banker on earth in his first outing. Pick a topic you can actually own, punt the framework fight to next year.
Maybe. I'd watch the question and answer more than the speech, though. That's usually where a new chair tips his hand on the thing everyone actually wants to know. Hawk or dove underneath the resume.
So Wednesday's minutes are the appetizer. Jackson Hole in 2 weeks is the main course, and you two don't agree on how spicy Wednesday's going to be.
Correct.
Just flagging it. And one more thing on Jackson Hole, worth flagging early. This year's theme is financial innovation, payments, the whole digital money stack. That's not just a Fed Nerds panel, that's a theme, with real teeth for anyone holding Bitcoin or Ether right now.
Fair callback for later in the show. Let's not spend it all here.
Before we leave the calendar entirely, Monday itself isn't a totally dead day either.
Empire State Manufacturing and the NAHB Housing Index both land Monday morning. Neither one's usually a market mover on its own, but they're the first real data points of a week that's about to get very busy, very fast.
Call it the appetizer's appetizer.
Noted. The calendar's got a much bigger, much more immediate test this week, though, and it's not the Fed at all. It's earnings, specifically retail. Walk me through the lineup.
Home Depot, Baidu, and Toll Brothers Tuesday. Target, Lowe's, TJX, and Analog Devices Wednesday. Then Thursday you get Walmart, Alibaba, NetEase, and Deere. 4 straight days of reading the American and Chinese consumer at once.
And Reddit joins the S&P 500 Tuesday morning too, before the open.
Which is its own small story. Index funds have to buy the stock, whether they like the fundamentals or not, the same mechanical flow we talked about a couple days ago. Tuesday sideshow, not the main event.
What's the main event?
Whether Friday's retail sales miss was real, down 0.6%, the steepest drop in over a year, and consumer sentiment came in at 51 against a call for 55. That's not noise. That's the softest read at the low end of the income scale in months.
I'd slow down before calling that real, though. One data point, one Friday, against 4 straight days of index records. If it were real, you'd expect the market to have actually reacted. The S&P was down 0.2% that day. That's a shrug, not a warning.
The markets had 4 days of AI earnings euphoria to hide behind. This is the week that... Excuse.
Runs out, I know. You've said that already. I just don't think one Michigan survey proves it runs out this particular week.
What are you each specifically listening for, starting Tuesday?
Trade down language. If Target and Walmart both talk about customers shifting to private label, more promotions, delaying big-ticket purchases, that's the tell. Home Depot's the cleanest read on the higher end too, because home improvement spending is one of the first things a stretched consumer cuts.
I'm listening for guidance, not vibes. Walmart's beaten and raised almost every quarter this cycle. If it raises again, that tells you more than one soft survey. And households under 50 grand a year cutting back doesn't necessarily hit Walmart's numbers, because that's exactly the customer trading down into Walmart, not out of it.
That's actually a fair point.
So, I have them occasionally.
Marcus, Steelman, her case for me. 10 seconds.
Fine. If Home Depot's ticket sizes are shrinking, and Target's traffic is soft on top of that, and then Walmart hedges even a little Thursday, that's 3 data points in 3 days pointing the same direction, and no amount of... It's just the low end survives that. That's the strongest version of it.
Thank you.
So where does that leave you two? Because it doesn't sound like you land in the same place by Friday.
We don't. I think by Thursday night we've got real evidence. The consumer's cracking at the edges, and it's not just a one-day headline anymore.
And I think Walmart's guide Thursday is the tell that Friday's number was noise. A stretched low-income consumer, sure, but not a broad one, and the index keeps grinding to records regardless.
Then here's the marker for anyone listening. Target and Home Depot both flag trade down behavior, and Walmart's guidance comes in cautious. Ashley's right, and this becomes the story of the fall. Walmart raises again, and nobody uses the word cautious. Marcus holds, and Friday was one ugly print in a strong summer. We'll know by Thursday night.
I'll hold there.
Whoa, same.
What about the ones that aren't the headline names? TJX, Analog Devices.
TJX is actually the one I'd watch as the mirror image of the trade down story. If Marshalls and TJ Maxx post strong traffic Wednesday, that's the same consumer stress showing up as a different retailer's tailwind. Off-price wins when people trade down. It doesn't need them to stop spending.
And Analog Devices is a cleaner read on industrial demand than anything retail tells you. Chips that go into cars, factories, medical equipment. If that guide's soft, that's a broader economy story, not just a stretched shopper.
So Wednesday alone gives us a luxury read, a value read, and an industrial read before lunch.
It's doing a lot of work this week.
And Thursday's not just Walmart either. Alibaba and NetEase report the same morning.
Which matters for a totally different reason. China's consumer has its own soft versus resilient debate running, and Alibaba's cloud and commerce numbers are about as clean a read on that as we get all month.
If Alibaba's domestic commerce numbers come in weak the same day Walmart hedges, that's not two separate stories anymore. That's a global consumer story, and a much bigger one than anything happening in Washington this week.
Topic 3, and it's the divergence that defined the whole weekend note. Gold and Bitcoin, which used to move together and very much are not right now.
Gold had back-to-back weekly gains, trading above $4,300 an ounce. Bitcoin broke above 65,000 earlier in the week on real ETF inflow, $853 million, and has given almost all of it back, sitting under 63,000 with back-to-back outflow days now.
Same week, same softer dollar, same cool CPI print. Why do they split?
Because they're not actually the same trade, and I think this is the year that becomes obvious to everyone, not just the people who've been saying it for years. Gold's bid is central banks, something like 750 to 850 tons of official buying projected for the year. That doesn't reverse on a bad headline. Bitcoin's bid was ETF-flow momentum, and flow reverses the second sentiment does.
Which is exactly the point, and it's why I'd push back on calling Bitcoin a hedge for anything right now. There's a prediction. Market pricing Bitcoin to beat gold this year at 23% odds. That was over 50 in January.
That's a big swing in 7 months.
It's a massive swing, and it's the market telling you, in real time, that the digital gold story took a real hit this year. Bitcoin's trading like a high-beta tech stock. Up when risk appetite's up, down when it's not. That's not a crisis hedge. That's just another risk asset with extra steps.
I don't disagree with any of that, actually. I just don't think it's a Bitcoin problem so much as a what do you actually want a hedge to do problem. Want inflation protection with a 2,000-year track record, you buy gold. Want convexity on a risk, on year, you buy Bitcoin, and this year, that's exactly what it's given you, mostly up, occasionally.
Ugly. That word's doing a lot of work when the ETFs are bleeding for a third straight day.
Fair. But the Ether side of the crypto trade tells a different story sitting right next to it. Staking rate at a record, Ether ETFs still taking in money. That's not crypto's broken. That's capital getting a lot more selective within crypto, the same way it's gotten selective within AI names the last 2 weeks.
So gold's the boring, steady bid, Bitcoin's the volatile one, and inside crypto itself, there's now a second split between Bitcoin and Ether. 3 divergences nested inside each other.
Which is exactly why risk-off hedge stopped being one trade this year. It's at least 3 now.
Topic 4. Oil and the Hormuz story, because it's the thread that's quietly been deciding almost every other call on this show for 2 weeks running.
It really has. The U.S. reimposed the naval blockade after another round of attacks on commercial vessels, and Trump's calling it a wall of steel, total control of the strait, in his words. WTI is up more than 7% on the week because of it.
Any actual path out? Or is this just sitting here through the fall?
There's real movement, more than the headlines are giving credit for. Iran and Oman have reportedly agreed on the coordinates for a proposed safe shipping corridor. They've been working technical, legal, and security details for 2 months now. Slower than anyone would like, but not nothing.
I'd want to see it actually open before I call it progress. There was a 2-week ceasefire back in April that collapsed inside the same month over an attack off Oman. This region's broken more promising-sounding talks than it's kept this year.
Sure, but the direction of travel matters. Coordinates on a map is a more concrete step than anything that came out of the April ceasefire.
And here's why I actually care more about this than almost anything else on the board. It's the mechanism that's beaten every rate call we've made for 2 weeks straight. Cool. CP. Flat PPI. Soft retail sales. The data keeps saying yields should come in, and oil keeps yanking them back up anyway. If Hormuz actually de-escalates this week, that's the first real chance the bond market gets to.
Do what the inflation data's been begging it to do all along. Fine. I'll agree with that much, at least until oil gives me a reason not to.
So a shipping lane negotiation between Iran and Oman might matter more to your yield view this week than Wednesday's Fed minutes.
Probably, yes. Painful to admit, but yes. And there's a real inflation math underneath this, not just a vibes number. Every $10 move in WT I historically add something like a quarter point to headline CPI within a couple months. If Hormuz stays closed into September, that's not an abstract geopolitical story anymore. That's a real input into whatever Wash ends up saying about the framework.
That's the strongest version of your case, all show, honestly. I'll give you that one, without a fight.
Rare moment of total agreement. Let's not let it go to your heads. Real quick, human moment. Because it's Sunday and I actually made real coffee this morning instead of reheating yesterday's for a 3rd time.
You oath.
I brought my own blazer this week, for the record. Learned my lesson.
Look at that. Week 2, and she's coachable.
Progress all around. Back to it. Last stop before calls. The AI-capex story. Because it's been running through basically every show this week and is not resolved. Marcus, your Friday call.
Lam Research and KLA closing green off. Applied Materials Guide. They did, both up big Friday, and the groups had a real run this year. KLA's up something like 80%. Applied Materials 120. Barclays just took its estimate for the wafer fab equipment market up to $154 billion this year, and 36% higher again in 2027.
For anyone who doesn't spend their mornings in chip fabs, That's just the tools chip makers buy to build chips. The equipment that makes the machines.
I'm not fighting the equipment story. The numbers are real. My question all along has been whether the picks and shovels guys are getting paid fairly for a boom that might not last forever. And that's a different question from, is the boom real?
Devil's advocate, though. Cerebras is up 120% off its IPO price at the peak and still just missed on GAAP revenue. Isn't 2 clean quarters a pretty high bar to ask of a company nobody agreed was cheap to begin with?
That's fair, and it's honestly most of why I'm being this stubborn about it. High bar, but it's the bar. The valuation set's not one I'm inventing.
And I still think the core revenue number, cloud and inference at 61% of the business now, is the more honest read of where the growth actually is. Same marker as before. Watch next quarter's hardware line. Neither of us has moved an inch.
Good, because that's exactly the kind of disagreement I don't want this show pretending to resolve just to wrap it up neatly. It stays open. Let's get to calls. And since this is a week-ahead show, these aren't for tomorrow's open. They're for the whole week. Checkable by Friday's close. Ashley, first.
Mine's on gold. If Wednesday's minutes show real hawkish descent, not a footnote, an actual fight, I think gold gives back some of this run and slips under 43.50 by Friday. If the minutes read stale next to everything since, gold holds this level or grinds higher into the weekend.
Marcus.
Mine's on the consumer, since that's where we actually disagree. Walmart's guidance Thursday comes in clean, no trade-down language. Another raise. I think the Russell keeps making records, and Friday's retail sales miss is forgotten by next weekend. Walmart hedges it all. Ashley wins this one going away.
So both calls this week route back through Wednesday and Thursday. Specifically, the minutes and Walmart's guide are doing more work than anything the Fed says out loud. We'll know both by Friday. Here's the week in one breath. Wednesday's FOMC minutes are the appetizer for a Jackson Hole that's now 2 weeks out. Warsh's first outing as chair. 4 days of retail earnings, Home Depot through Walmart either confirm Friday's consumer crack or bury it. Gold and Bitcoin keep proving they're not the same trade anymore, and inside crypto itself, Ether's quietly outperforming its bigger sibling. Oil and the Hormuz talks are still the wild card sitting underneath the whole rates conversation, and the AI-capex trade keeps splitting into winners who convert and everyone else, with Cerebras still the one nobody's agreed on. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and find our written notes at novaventures.us. That's your Sunday setup. Have a great week, and we'll see you tomorrow morning.